Hi, you're listening to Mind Your Business with Karla Dennis, and I am Karla Dennis. All the years that I've been in business, I have to tell you, I've seen so many business owners lose their business, make critical mistakes in their business because of lack of knowledge. I want to provide you with great tools and content so that you don't make these same critical mistakes in your business. All right, I'm excited to go over Karlas' mailbag this week because we have a lot of great questions that have come in, and these are some really good, deep questions. Listeners have been out there paying attention, so I am ready to give you some answers. Our first question is coming in regarding electronically filing tax returns. And the question is, my electronic tax return keeps getting rejected for a dependent Social Security number used by more than one person on the return. I verified the Social Security number of all my dependents with the Social Security Administration, and no one else is authorized to claim our children on their return. How do I correct this error, and is there a way for me to e-file the return later on? And I'm so glad this question came through because this is such a common problem. Now that we've gone through the electronic filing process and we're able to electronically file tax returns, we are now seeing where other people are starting to utilize someone else's Social Security number, sometimes by accident and sometimes on purpose, fraudulently. People are using your Social Security numbers of your other dependents. And so it has been a problem for quite a while. And it used to be that you had to mail your tax return in by paper, do an actual mail-in return. But now IRS has come up with a new procedure where you can get a tax identification number, like a PIN number, that every time you go to file your tax return electronically, your tax professional has to have that PIN number. That PIN number authenticates you as being the real taxpayer. So now your return can go through electronically. The very first year it happens, you won't be able to do that. You will have to mail it in. But after that, you apply to get that PIN number and you'll be okay moving forward. I wish they can catch some of the people that are doing that, but apparently our government doesn't have enough money to make that happen. All right, our next question is coming in. Can I deduct the administrative expenses of my father's estate? And if so, how am I able to do that? And an estate is created when someone passes away. When we have an individual that has passed away, an estate is automatically created. Yes, you can deduct the administrative expenses, but you have two options in order to deduct it. You can deduct the administrative expenses off of the estate tax return, which is a 706 tax return for the estate. You can deduct those expenses against the gross income, or you can deduct those expenses on the final income tax return of the estate, which is a 1041 form. So there's two ways to do it. On the estate tax return, which is a 706 form, to lower the estate tax, or the income tax return, which is the 1041 form, to lower the income tax of the final estate. Just remember, you cannot deduct them in both places. So you want to kind of analyze and choose which way you want to go in that particular case. But that's a very good question to ask. Let's see here. We have another question that has come through, and this one is talking about the IRS has corrected my return and sent me an additional refund. Well, lucky you. Glad to hear that, right? Does this mean I am also entitled to an additional refund on my state tax return? That's a really good question. And the answer to that is maybe. It depends on why IRS adjusted your tax return. If they adjusted your tax return for an adjustment that is also a tax deduction on the state, then yes, you will also be able to amend your state tax return and possibly get a refund. But there are items that we have on our federal tax return, for example, state unemployment tax, certain depreciation items that are not deductible to the state, so you may or may not be in that position. The best way to handle that is to make sure you get with your tax professional, allow them to analyze that situation. And if you do have a refund coming, you do have to act. The state is not going to automatically recalculate your tax return and send you a refund. That would just be too wonderful. You actually would have to file an amended tax return. And we're going to be talking about amended tax returns later on in the show. All right, let's see. We had another great question come through. And this is a very interesting question. It talks about if I receive life insurance distributions before death, can I be taxed on the income? And the first question you're probably asking is, how do you receive life insurance benefits before death? But let me tell you, it is possible in a couple of different ways. One way is if you have an accelerated benefit rider, for example, on your life insurance policy, which will accelerate some of the benefits being paid to you prior to your death. Maybe you've come down with something where maybe you have cancer and you're not going to survive that. They're willing to front some of your benefits. You can have certain things that will front your benefits up to you prior to death. Now, those benefits are typically not taxable unless there's interest being earned on the account. So let's say, for example, if your life insurance policy was maybe like $100,000, that's how much your life insurance policy was. And when you got some of those accelerated benefits, maybe the policy had grown to maybe $125,000. There's some interest on the policy. Any of the interest is going to be taxable, but not the face amount of the policy will not be taxable. Also, you can borrow against your life insurance policy. Sometimes people think those are distributions. Those are really loans, and a loan is not taxable to you if you're borrowing your own money out of your policy. Even if you are taking the interest, it will only become taxable to you when there is a payment of the actual proceeds of the policy, either from your death or accelerated benefits. So that was a really, really great question. My recommendation there to anybody that is getting life insurance or even considering it to look into those accelerated benefits, because we are starting to live longer and things are starting to happen. We're being able to get some of that money from our life insurance policy prior to our sudden demise can put us in a great position. I have another question that came through. It says, how do I determine the amount I must withdraw from my IRA or my 401k to avoid any penalties? Well, number one, you will want to make sure you're over 59 and a half. If you're pulling money out of any 401k, any IRA account, any deferred account before you're age 59 and a half, you will be penalized. But it sounds like this question is going more toward an individual that may have to take what we call minimum required distributions, or what we say for short, MRD. If you are 70 and a half and above and you have money in deferred accounts, you have to start taking minimum distributions of that money. And basically the way that's calculated is that we look at your value in all of your accounts, every deferred account you have on December 31st, whatever that value is, and then we divide that by your life expectancy, which is actually calculated, and that's the amount of your minimum distribution that you have to take every single year. Uncle Sam does not want to continue to have people defer that money. They do want that money to start coming out. They've set that age of 70 and a half is that age where you have to start pulling that money. Now, especially that people are living longer, you want to make sure you have that retirement account on point and you have enough money to retire, because now you need that money for a longer period of time. That is actually a great question. I like that a lot. And you definitely want to get with a professional to really help you figure that one out. All right, here we have another question. Does a corporation have to file a tax return if it has no earned income and basically been inactive for a year or more? Absolutely, yes. If you have formed a corporation, you have an automatic compliance requirement to file that corporate tax return every single year. Some states have a minimum tax, like the state of California has a minimum tax, When you don't file that corporate tax return and you don't pay that minimum tax, your corporation will go defunct, and that will follow you forever. So you do have a filing requirement. A lot of people start corporations that they never, ever close up. They just kind of let them go by the wayside. I would say with all the technology we have where we can Google and find out things on individuals, I would button up all of my prior tax situations, make sure that I file the returns appropriately on time. And if I'm done with that corporation, do a dissolution, close the corporation up, and be finished with it. And that way you don't have to worry about it. All right. Here's another question. This is actually a good question. I love this one. It says, are these limits on the amount you can deduct for business travel? Are there limits on the amount you can deduct for business travel? And that's really a very interesting question. So it depends on what type of business travel you are doing. Typically, there are not limits on business travel that are ordinary and necessary for your business. So then who defines ordinary and necessary? It really depends on who you're sitting before an audit. The auditor really will start defining ordinary and necessary and will try to limit your benefits. But as a rule of thumb, there's no limit on your travel. However, if you are doing travel like on a ship or some type of vessel, there are daily limits to your travel. A lot of people have started going to seminars on cruise ships and just have really taken that continuing education to a different level, which I'm not opposed to that either, but there are daily limits when you do that type of traveling. So we want to be very careful there. Remember, when you are documenting your travel, you want to make sure that you keep great documentation. You want to keep your receipts. You want to keep a travel log of where you went, why you went there, and what was the business that you conducted. And that's very important. That is even above and beyond the receipt, is to make sure you keep a travel log, because IRS does mandate that you have a travel log. Anytime you're traveling, you have a log for meals and entertainment, and they will ask you for it in the event of an audit. So that's really the key there. Travel all around the world if you like. Just make sure that you document your business travel and you keep really good records there. That's a very good question, because a lot of people travel for business. If you have any questions and want to talk to myself or my guests, please reach us at 800-721-7374. That's 800-721-7374, or reach us at nybuniversity.com. That's nybuniversity.com.